Did you know the IRS is going to tax your 401k? Take a lot of your money? Well, sis, today we're talking about how to keep some of your money and keep the IRS hands off your money for your 401k. I'm Dakota Grady, teacher the money coach, and I'm all about helping you to master your finances. Let's dive into the conversation. You build your 401k and you want to keep the IRS's hands off your money? Well, we all do, but how do you minimize that? Well, today we're discussing just that. You got to understand how you're going to get taxed when it comes to your retirement. So the first thing is, it's going to be taxed. The first thing you got to understand about your 401k is it will be taxed, because a 401k is not like a Roth IRA. You're investing with the money that was not taxed yet. So you put money in this account, it's growing and growing and growing. You're looking good, looking nice. But when it comes to you taking the money out to withdraw, you're going to be hit with a tax bill. It's going to cut your money. It depends on your tax and income level, and it can hit you with a big tax bill. So you want to be aware of that. I want you to be aware that you will pay tax on your 401k. Second thing is, if you take money out of your 401k before you're age 59 and a half, you're going to pay a penalty in addition to paying taxes on it. This is how that works. You take your money out for get a car. All right. And you need a car. You don't have the money set aside. Take the money out. Good. At the end of the year, you'll get a Form 1099-R, and they're going to show the money you took out. And if you withheld any taxes, more like you didn't, that money will be added to your taxable income. And on top of that, you're going to pay 10% tax of the money you took out. So you took out $30,000. That means you're going to pay tax of $3,000 plus taxes on the entire amount. Your W-2 wages plus the money you took out plus the penalty. All right? So be aware of this stuff. And then if you take money out and you say you're over age 59 and a half, third thing is, if you're over age 59 and a half, you kept the money in there like you're supposed to, you didn't withdraw early, but you got a big account balance. And on top of that, you make more money. So you're going to pay a higher tax rate because you make more income and you're in a higher tax bracket. And you're like, oh my goodness, I'm going to pay all this tax on my retirement? Yes, you are. But here are some things you can do to combat that. The first thing is, get your Roth IRA. Why a Roth? Because a Roth allows you to invest money and it goes tax-free without you having to pay tax on it when you take the money out. The money you put into it is already taxed. So it's going to grow tax-free. So you take the money out of your retirement account and it's not taxed like the 401k. 401k is going to grow. Take money out, you're going to pay tax on it. So what I did was I had a 401k, rolled it over to a Roth IRA, and I pay tax on the money so that now my Roth is growing tax-free. You should do the same. What you can also do is set money aside. If you feel like you're going to have a tax bill over time, set money aside, say in a sinking fund. You want to take 10% out every year, put it in an account, just sit there when you feel like you're going to retire in 20, 30 years. Imagine having that big stash of cash there sitting for ready to pay taxes. Or maybe you can just set, when you take money out of your 401k, withhold some taxes. That way, when you file your tax return, you would have withheld money from the money you took out of your 401k. And the last thing I recommend doing, if possible, start a business, because you can increase your income, but also reduce the taxable income by having expenses that are ordinary and necessary for your business. So if you have a business, say like me, I do accounting and taxes, I can deduct my uniform, I can deduct my mileage if I go see a client, I can deduct meals for having a meeting with a client, I can deduct my office expense such as QuickBooks Online if I'm using that, or if I'm using Adobe, if I'm using that as software. You can deduct things that you can't deduct if you just an individual taxpayer. And if you have a loss for your business, so you have more expenses to income, the loss will offset your income from your wages, your W-2 wages. Therefore, you'll be taxed on wages from your job, your 401k withdrawal, and you'll have a loss which offsets those two other sources of income. Now, I hope this was beneficial to you, and keep watching the next video to get value about how to master your finances.